Welcome back to the deep dive. We cut through the noise to get you insights that, well, actually matter.
hmm
Today we're jumping straight into two core financial ideas. Once you get these, honestly, your understanding of personal money stuff and the whole world of business finance gets significantly sharper.
Yeah, definitely.
Think of it like a fast track, a way to get quickly informed with some powerful calculation tricks and the absolute foundation of business accounting.
Exactly. And that's the goal, isn't it? These aren't just like abstract theories.
No.
They are really vital bits of knowledge. They help demystify things that can seem pretty complex.
Right.
So whether you're thinking about your own investments or trying to figure out if a company's doing well, or maybe just wanting to follow the financial news with a bit more clarity, these concepts are, well, they're essential.
Okay.
We've basically pulled out the key nuggets from our sources, just the practical stuff you can use right away.
Perfect. Okay, let's unpack this first one. It's incredibly useful, kind of a favorite tool for quick financial estimates. The Rule of 72.
Ah, yes. Good old Rule of 72.
Yeah. If you've ever wondered, without needing a calculator, how long it takes for your savings to double, or maybe less fun, how fast inflation might cut your spending power in half.
Right.
This simple formula, it's like your new best friend. It's just a really neat way to approximate compound interest effects.
And what's so good about it really is just how simple it is. It's elegant.
It is.
It's a mental shortcut, right?
Yeah.
You skip the complex math. It lets you quickly guess either the time frame for growth or maybe the rate you'd need to hit a certain goal.
Exactly.
It gives you that quick sense of scale, which honestly is invaluable. Things move fast in finance.
Totally. And the main formula is just beautifully simple. To find the number of years it takes for something to double, you just take 72.
Yep.
And you divide it by the annual interest rate. That's it.
So straightforward.
So say you have an investment, maybe it's growing at, let's say, 6% a year, steadily. Using the rule, 72 divided by 6 gives you 12. So about 12 years for that investment to double. It's that easy.
And the practical side of that for, your own financial planning is huge.
Immense.
Think about comparing different savings accounts or maybe a long-term bond,
Right.
or even just picturing, say, how inflation affects future costs like college tuition.
Right. That's a big one.
This rule just gives you an instant sort of tangible mental picture. You can quickly see how even a small difference, like 1 or 2% in the interest rate or inflation,
Yeah.
how much that changes the timeline. It's great for getting you thinking long-term about your money choices without getting bogged down in like all the tiny details. When I first learned this rule, it really clicked for me just how powerful compounding is.
Oh, yeah.
Makes you wish you'd saved your allowance more seriously back then.
I know exactly what you mean. And what's great, too, is you can sort of flip the formula.
Right.
If you have a target in mind, like, I want to double my money in X years, the Rule of 72 tells you the interest rate you'd need. So the rearranged formula is required interest rate equals 72 divided by the number of years.
Yep, just flip it.
So if you want to double your investment in, say, 9 years, you calculate 72 divided by 9, that's 8. So you need an 8% annual interest rate to hit that goal.
That's a really key point. It works both ways. Now, it is important, like you said, these are approximations.
By estimates.
They're not laser precise down to the decimal, but they're surprisingly good for, let's say, typical investment rates, maybe between 5% and 15%, especially if interest is compounded annually.
Okay.
It gets a bit less accurate at really high or really low rates, or if compounding happens more often than once a year.
Good caveat.
Yeah, so think of it more like a reliable compass than a super precise GPS. It gives you a quick, useful direction for those mental checks in real life. It's about building that gut feeling, that intuition for how money works over time, which is just, critical for financial literacy.
Absolutely. A great mental tool. So we've got that quick personal finance shortcut. Yeah. Now let's shift gears. We're moving from your savings to, well, the fundamental backbone of how every single business, small local shop or massive corporation, keeps score.
Okay.
Here's where it gets really interesting. The accounting equation.
Ah, the big one.
Yeah. This isn't just some dusty formula from page 1 of an accounting textbook.
No, not at all.
It's the core principle. It underpins how companies organize everything and, crucially, how they show their financial health to the world.
That's a really important distinction. The accounting equation, it represents this fundamental link between what A company owns its assets,
Right.
what it owes its liabilities,
Right.
and what's left for the owners, the equity. It's way more than just math. It's the absolute bedrock of double-entry bookkeeping.
Which is the standard system, right?
For centuries, yeah. And what's fascinating here, and this is key for anyone looking at company reports, this equation is the direct foundation for the balance sheet.
Okay, so let's make that link explicit.
It's why the balance sheet always has to, well, balance. Every single transaction has to fit this equation, keeping both sides equal.
That makes sense. It forces everything to add up.
Mm-hmm.
So let's state the equation clearly first, then we can really break down the pieces. It is assets, liabilities plus equity.
Simple looking, but profound.
Exactly. Okay, let's break it down, component by component, starting with assets.
Yeah.
When we talk about assets, what are we really talking about? What's the core idea?
Okay. Assets. These are basically all the resources a company owns, things that have economic value and are expected to bring some future benefit.
Resources they use to operate.
Precisely. Resources to operate and make money. And it's not just physical stuff, though that's part of it. Of course, you've got cash, the equipment they use, the buildings, maybe land.
Obvious ones.
Right. But it also includes stuff like inventory, the products sitting there waiting to be sold, and accounts receivable.
Which is money owed to the company, right?
Exactly. Money customers owe them for things they've already delivered. Even intangible things can be assets like patents, trademarks, or sometimes goodwill if they bought another company. Anything with value they own.
Got it. Okay, so if assets are what a company owns, then liabilities. That sounds like what it owes. Is that right?
Spot on. Liabilities are the company's obligations to outsiders. Debts, basically. Things they have to pay back or settle in the future.
Like what? Give us some common examples.
Sure. Well, bank loans are a big one.
Okay.
Accounts payable, that's money owed to suppliers for goods or services they've already received but haven't paid for yet.
Right.
Mortgages on those buildings we mentioned. And bonds payable, that's when companies borrow money directly from investors by issuing bonds.
So looking at liabilities tells you about their debts, their risk.
Exactly. It gives you a picture of their financial commitments. High liabilities compared to assets could mean more risk, especially if interest rates go up or the economy slows down. Managing liabilities well shows the company is being careful.
Makes sense. Okay, that leaves the third piece, equity. You sometimes hear it called net assets or owner's equity. How do we explain equity? What does it represent?
Equity is essentially the owner's slice of the pie, or the shareholder slice if it's a public company. It's what would be left over for them if the company sold off all its assets and paid off all its liabilities. It's the residual interest.
So what's included in equity?
It includes things like common stock that represents the value of shares sold to investors, and retained earnings.
Retained earnings.
Yeah.
Those profits they keep.
Exactly. Profits the company has earned over time and decided to reinvest back into the business instead of paying out as dividends.
Okay.
So when a company makes a profit, that increases equity. If they pay dividends to shareholders, that reduces equity. Looking at the mix, how much is from initial investment versus profits kept can tell you something about how mature the company is and its strategy.
You know, the beauty of this equation, the way you've explained it, is how clearly it shows that all those company resources, the assets they had, to come from somewhere.
Right. They don't just appear.
No. They were either financed by borrowing, creating liabilities, or by funds from the owners creating equity. It's just, it's logical. It shows how businesses get and use their stuff. And it's the absolute foundation for that balance sheet.
That's a really crucial insight. Assets have to be funded either by debt or by ownership. And this logic leads straight into something called the dual effect principle.
Dual effect.
Yeah, it's built right into the accounting equation. Every single financial transaction a company makes, it always affects at least two parts of this equation, always. And it keeps everything perfectly in balance.
Okay, let's make that concrete. The example from our source. A company takes out a loan to buy some new equipment. What happens then?
Right. So two things happen. First, its assets go up because it now owns this new piece of equipment.
Makes sense. Asset side increases.
But at the exact same time, its liabilities also go up by the very same amount because it now owes that money back as a loan.
So both sides of the equation increase equally.
Precisely. Assets went up, liabilities went up. The equation assets, liabilities plus equity stays perfectly balanced. It's like financial double entry bookkeeping in action. Every
Uh,
transaction has two sides.
It guarantees everything adds up.
Exactly. That dual effect, it's absolutely central. It ensures the financial statements, especially the balance sheet, stay balanced and give an accurate picture. It's not just theory, it's the built-in check that gives us a reliable snapshot of where the company stands financially at any point in time.
So important.
Yeah, without it, financial reports would just be chaos, unreliable, useless for making decisions. It brings transparency and accountability. That's why investors, lenders, managers, everyone relies on it.
Okay, so let's wrap this up. What does this all mean for you listening?
Well, we've just unpacked two really powerful concepts.
Hmm.
First, the rule of 72 gives you that quick, handy way to estimate financial growth or even decay, like with inflation.
Super useful shortcut. And second, the accounting equation, giving you that foundational grasp of how businesses track everything, how they stay balanced, and specifically how it underpins that crucial balance sheet report.
Right.
These aren't just, abstract formulas. They are real tools for insight.
And that really is the main takeaway, isn't it? These basic ideas are so valuable whether you're looking at your own money or trying to understand the wider business world.
Definitely.
They show how things that seem complex, like finance and accounting, can often boil down to some pretty simple, elegant formulas that unlock a lot of understanding. They're the starting blocks, really, for building better financial know-how.
So maybe something to think about as you go through your day is this. How could understanding these two equations, rule of 72, assets, liabilities plus equity, empower you?
Mm-hmm.
How might they help you ask better questions? Maybe about your own savings plan or an investment you're thinking about, or even just when you read the news about a company's performance. How do these simple tools give you a fresh perspective on the world of money?
And that really raises an important question, doesn't it? What other financial ideas that seem complex might also have simple, powerful principles at their core, just waiting to be understood? These two are really just the beginning of the journey into finance and accounting.